Good morning. Calling to order the Equity Committee's Public and Private Committee today being Wednesday, March 10th. It is at 8 a.m. Before we proceed, I will ask the Secretary to please read the instructions.
Thank you, Mr. Santos. It's Carol. Good morning, everyone. This meeting is being conducted as a virtual meeting, so I'll do a roll call of all the trustees to confirm attendance. Mr. Keough? Mr. Oakham?
Here.
Ms. Greenwood? Mr. Green?
Here.
Chair Santos?
Present.
Mr. Knox?
Morning, I'm here.
Mr. Bernstein?
Morning, everyone.
Mr. Kelly?
Present.
Ms. Sanchez? Staff participating in today's meeting include Principal Investment Officers Chris Wagner and Ted Wright, guest speakers Ian Aker of Stepstone and Nathaniel Everett of State Street Global Advisors. Trustees, if you have a comment or any questions on any item, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now, Chair Santos, we may proceed with the agenda.
Thank you.
You're welcome.
Next item of the agenda is approval of the minutes. Is there any for December 9th, 2020? Is there any changes, corrections, amendments? Hearing none, I will entertain a motion for approval.
I can't move, can I, Herman? This is Ron Oakham. I'm not on the committee.
You are on the committee.
Yes.
Am I on the committee?
Yes.
Okay. I move it.
Okay.
Thank you.
I guess I'm looking to December of last year. I wasn't on the committee.
Well, I'm on the committee. I second.
Thank you,
Yeah.
Ms. Greenwood. Yeah.
Good. Ms. Greenwood is present. That's great. So we have a motion that's been duly seconded. Roll call, please.
Mr. Oakham,
Yes.
Ms. Greenwood,
Yes.
Chair Santos,
Yes.
and Mr. Keough. Yes, he's not present. The motion passes. Unanimous. The motion carries.
Mr. Green may vote as alternate.
Oh, Mr. Green?
Aye.
Okay, the motion passes unanimously. Thank you.
Great. Thank you very much. Next item is going to be reports. Excuse me. Next item is actually public comment. I have not received any or seen any requests for public comment. Have we received any public comment requests?
We have not.
All right, thank you. Next item is going to be reports, and that will be item 4, subsection A, private equity education. Mr. Wagner.
Good morning, Mr. Chairman, members of the committee and trustees in attendance. With technology stocks driving much of the uplift in the 2020 public markets, the number of private equity firms investing in tech, and as you've seen and through various private equity investment memorandums, the current overweight to technology in the portfolio, we thought it'd be a good idea to have an educational session on private equity technology investing. So to that end, I'd like to introduce to you Ian Aker from Stepstone to lead the session, the educational session. Ian is a partner on the private equity team at Stepstone, focused on U.S. buyout, large and middle market funds. He also spends a considerable amount of time on technology-focused funds and co-investments. Prior to joining Stepstone in 2008, Ian was a vice president with the Alternative Investment Capital in Tokyo, which is a private equity fund of funds and advisory firm. And before that, he worked at the Pacific Corporate Group, a private equity investment firm that oversaw over $15 billion of U.S. private equity commitments for institutional investors. So with that, I will turn the presentation over to Ian Aker from Stepstone. Go ahead, Ian.
Thanks, Chris. Can everyone hear me all right?
Yes, we can.
Great.
And nice job, Carol and Chris. It's not often people pronounce my last name correctly, so it was impressive. Yeah, as Chris highlighted, today's presentation is really, the intent here is to focus on, why invest in technology. I understand we have about 30 minutes here. I'll try to, give about 15 minutes of commentary and then save the rest for Q&A. So we'll try to move quickly through these slides, but feel free to, jump in if there are any questions at any point in time. Really, the goal is to try to tackle 4 key topics. Why invest in this space, a bit about the size and scope of, the IT market, talk through a bit about how, the space is performed, and then, give some key considerations or food for thought. So maybe to start, if we could go to slide 4, on the why in invest in technology, to level set a bit, as we talk through technology, one of the larger themes to invest behind has really been software. Back in 2011, Mark Andreessen, a well-known tech investor, was quoted in the Wall Street Journal saying, "Software is eating the world." What he was really getting at was that, we're in the midst of a dramatic, technological and economic shift to where software companies are taking over huge, swaths of the economy. The chart on the top right really illustrates that point. The software sector has been growing at nearly 3 times GDP for almost 20 years now. And COVID is been really accelerating that point as remote working has emphasized the need for businesses to further digitize supply chains, customer channels, engagement with employees, or even the case of today, this call being conducted via Zoom. That really provides a bit of color as to what's driving the growth. But there are a couple other themes that I would highlight on the private equity side that's really had investors find the space compelling. One being customers tend to come back every year. Different from, say, a restaurant that every time a customer walks out the door, you have to replace that customer. That's not the case in software. The cost of switching is also incredibly high in the space. And once a piece of software becomes ingrained, it's very hard to rip out. The final point is really the idea that software, you build it once, i.e. you write the code, and then you sell it many times. And as a result of that, these businesses tend to have a lower cost of goods sold, lower CapEx, and as a result, generate high margins and high free cash flow and are highly cash generative. So, all fundamental attractive components for software investors. If we go to slide 5, when we compare the public and the private markets, tech exposure in the public markets is really dominated by a few large cap businesses, where the private equity landscape is highly fragmented. And to illustrate that point, the chart on the bottom right shows the FANG, or Facebook, Apple, Amazon, Netflix, Google, and Microsoft represent nearly 25% of the S&P 500. I'll say that a bit differently. 6 technology companies represent a quarter of the S&P 500. I find that an astonishing figure, but that gives you a little bit of sense just on the public side. With the large swings in the NASDAQ over the past few weeks and days, I'm sure there are some natural questions around valuation. However, I'd say that one of the benefits in the private market is that we're not as impacted, by those swings, day over day or week over week. We certainly pay attention to where valuations are at, but really focus on long-term assets and identifying long-term themes to invest behind. The chart on the bottom left, bottom right, in 2023, the software space alone, they're expected to be almost 300 small and mid-cap companies to every large cap company. So that really illustrates, take outside the public component, that illustrates the investing landscape across, the private space and just how truly fragmented that space is. If we flip now to slide 6, we'll drill in a bit more on the market size and private equity. Over the past few years, somewhere between 22 and 31% of the dollars raised has gone to tech-focused PE funds. So here, I think groups like Vista or Silver Lake or Thoma Bravo, some of the names you're likely well aware of. That really illustrates that sector-focused GPs and what they've raised, but doesn't really take into account some of the generalists who've also been investing in this space as well. Therefore, using that as kind of a precise benchmark is a bit tricky. But again, somewhere between 20 and 30% of the capital raised has been to specialists. If we flip to slide 7, this really gives kind of an illustration of where the investment activity has been in the private markets, private equity. We've seen IT capture around 12% of deal volume in 2010, but that increased to 32% of deal volume in 2019. Given the capital that has been raised and the interest in the space, it's not inconceivable to see that number continue to increase. One area we've focused on in particular and continue to keep our eyes on is the multiples that have been paid in this space. With interest rates where they are, multiples have expanded across all sectors. However, IT and healthcare has seen the biggest shifts, both increasing by nearly 50% over the past decade. You can see that in the bottom right chart. Perhaps that signals a flight to quality during this period of uncertainty, but nonetheless, something we're keeping an eye on. Also, keep in mind that there's a bit of a natural re-rating that has gone on in the space as we've seen more activity. We've also seen for consideration what are often referred to as tech tourists, groups that don't have as much experience coming into the space and bidding up assets. So again, something we're keeping a close eye on. On slide 9, this slide really touches on some of the performance figures. Or actually maybe go back one slide, or actually no, sorry slide 8. Sorry, thank you. This slide really touches on some of the performance figures, really comparing public and private markets. The software index of the S&P 500 compared to an index of software publicly traded companies. That software index has grown by nearly 3 times that of the S&P. A natural question might be, is this sign of .com part 2? I'd say one distinct difference here is that most of these companies today generate real revenue and real profit. The emergence of AWS, cloud hosting, the prevalence of everyone having an iPhone in their pocket, 5G, mass software adoption across industries. The reality is that technology companies can monetize and scale more rapidly today than they could in the past. And so I think there's some long-term tailwinds that continue to benefit this space. The bottom chart, and what we're most focused on here today is just talking through private markets and how IT is done. As Chris mentioned earlier, you all are overweight, and that's certainly benefited your portfolio over the past decade. IT in particular has generated some of the strongest returns. This chart illustrates both the IRR and the TVM, and also shows the loss ratio, which is a metric we closely track to illustrate kind of volatility. And so it's generated some of the highest risk-adjusted returns that we've seen. Maybe in the interest of time, I'll skip to slide 11. and really would encourage you to refer to the two prior slides when time permits, but just the punchlines there are that IT and software also performed exceptionally well during COVID. The other thing I'd highlight is that the benchmarking the asset class can be a bit tricky as well, particularly when looking at the public markets. Some of the largest tech focused platforms are actually from a GIC sector perspective classified as communication services or financial services or consumer discretionary in the case of Amazon or an Airbnb. But this slide here really highlights some of the key considerations we're thinking about when considering making new commitments in the space. There's a lot of capital that's been raised in targeting the space. As I mentioned earlier, there's not only specialists, but generalists are also investing in the space. Valuations have gone up significantly, and is something that we're keeping a close eye on. And then some of the GPs that have generated some of the strongest returns in the space have become very large GPs. So a decade ago, the Vistas and the Thoma Bravos of the world were covered by our small market team and were sub-billion-dollar funds. Today, they're some of the largest funds that have been raised out there. And so I think we continue to monitor that dynamic as well. And we'll maybe pause there just in the spirit of leaving some time for Q&A and open it up for questions.
Where do you think the future is going to go, and how are you going to proceed, with your investments and your fund?
Yeah, look, it's a good question. I mean, there is one of the things that we really emphasize. It's hard to predict with certainty the future, but given some of the risk factors that we've highlighted, we're keenly focused on investing with sector specialists, groups that know the space inside and out. We've seen some of the generalists pay some very high prices, so I think that's going to be a key focus area for us. I think given the tailwinds I highlighted, there's a continued runway of opportunity, but one of the things we're continually focusing on is finding some of the smaller growth equity, small buyout tech focused firms as well, continuing to dip down into more of the inefficient segments of the market to be able to capitalize on some of those areas. So that I don't spend time on the portfolio construction side with Natalie and Jose here, but if there's any other specific things that they'd like to add as it relates to your all's portfolio, but just as we think about the landscape and technology investing, again, I'd say there's continued tailwinds and a reason to focus on the space, but an emphasis on continuing to dip into the smaller side where the market tends to be a lot more inefficient and you're not as penalized by some of the high prices that are being paid at the larger end of the market.
Sanchez.
Oops. Thank you for your presentation. So this is a question I actually posed to Robert Smith as well. But it seems that when tech first became its own a sector, or when we sort of really started to identify with it, was at a time when tech were pure tech companies that were broadly exposed to sort of many and all sectors. Now there are, tech has become the infrastructure sort of underlying every sector, which means that at some point, sometimes you take specific sector risk in combination with whatever tech play that you're kind of attempting. So now you have fintech, medtech, health tech, you just put tech at the end of it. Really, it's just that it's the infrastructure behind so much of what we do today. At what point, or how does this kind of make investing in tech more or less challenging? When Palantir came forward with their IPO, everyone underscored the exposure they had to the energy sector, et cetera, et cetera. So these are real risks that are expressed through these various tech investments that, as you say, they are certainly very scalable and high margin, but what does that do for the process?
Yeah, no, it's a good question, and frankly, I think we see it as kind of an interesting opportunity set, because as you highlighted, tech investing has been a lot more than just exposure to software. For instance, there are subsectors where the software is servicing. So you can think about insurance software, healthcare software, and so your underlying exposure may be to tech, but ultimately you're exposed to those subsectors which they're going after and trying to find a solution for. I'd say ultimately, one of the benefits of software investing is that you are not investing typically behind high cost systems. These are typically mission critical systems that institutions use as part of keeping the lights running, keeping their business going day to day. And so when it comes to periods of volatility, which I think is kind of what you're getting at in terms of whether that may have some knock-on effects, it's typically not the first segment to get cut, or the first line item in a budget to get cut, because of how mission critical the software and services are in terms of being a system of record for these businesses. Once it's integrated into the business, it becomes very difficult to rip out. And even just COVID and kind of the first period between March and call it late summer, we saw that play out across a number of companies in the space, and that maybe they were not growing as quickly because the sales cycle extended, but they were not churning or losing customers, different from an industrial business or a consumer facing business.
So we talk about buying opportunities, and can you talk about ex-US, specifically with the emerging markets, like Latin America? I know China is high tech is a big deal, and also how venture capital and growth equity play a role in these opportunities.
Yeah, no, it's a great question, and frankly, there's a huge opportunity set that both our team on the ground in Brazil, as well as our team in Asia are going after. As you're probably well aware, these are private markets that are highly underpenetrated. These are some of the largest growth engines of the world in terms of GDP, but also in terms of capital deployment, underpenetrated when you look at private equity, relative to GDP, and compare that to that of developed markets. So that in and of itself is a really interesting dynamic, combined with the growth tailwinds. But there is a massive opportunity, across the markets you highlighted to pursue. And it frankly, in the Brazil market, that tends to be more of a buyout market, and there is that opportunity set. In China, it tends to be a bit more of a growth equity opportunity set, but there is a lot of really interesting venture that's going on, and being able to help fund and facilitate and create the Airbnb of China, or the Amazon of China. There's been some huge successes that have taken place, across the private equity landscape, and frankly, a big opportunity set that our teams are going after in those geographies.
Yeah, so especially in the Pacific Island countries, looking at Brazil, which is the largest economy in Latin America. But when you look at the Pacific Island countries, Chile, Peru, Colombia, and Mexico, it appears to me that there's a tremendous opportunity there for us. Any other questions, comments, concerns? So Mr. Grable and Mr. Wagner, and I guess Mr. Fernandez, great presentation. Thank you very much. So we are going to look at this opportunity as part of the asset allocation, or just a review of the private equity. How is this going to be implemented, if approved by the board, obviously, into the program?
Well, our goal today, Mr. Santos, was just to, I guess, assuage any concerns that the board had about the private equity portfolio being overweight technology. We anticipate that we'll still be bringing, funds to the board for review that have, technology practices or are focused specifically on technology, and we just. Really, the goal was to let you know that the market is big, it's growing. Stepstone's got a great handle on what's going on around the globe, as does the LACERA private equity team. But we just don't want there to be any concerns should our overweight in the particular technology sectors grow. It has an area that's performed well. And we anticipate that there'll still be continued investment there. And we just wanted to, keep the board apprised of what's happening in the market, so that when you see these funds, your concerns, as I said earlier, are allayed, from just the size of the whole technology market. So that's really the goal here. I know we have a strategic asset allocation coming up, but this presentation was just specifically about just the technology investing sector, and to give you a sense of what's going on there. I think John may have a comment.
Mr. Grable.
Good morning, Mr. Chair, trustees. Building on what Chris said, I would view this discussion as something that will feed in to the next structure review that we do for the growth portfolio, for the equity portfolio, to discuss how we implement the allocation that the board chooses by virtue of the strategic asset allocation. I think that one thing I'll also build upon is what the point that was raised by Ms. Sanchez, which is, when we think about technology investments, and this is the conversations that we have with prospective partners and with existing partners in diligence, is looking at their investments either as platform, horizontal type investments, or vertical, more application type investments. And there's tremendous differentiation in terms of and degree of difficulty. If you build a platform, it's a lot harder to do, but potentially has much greater value. Application may be easier to do, but is more of a point solution and may not have as quite the multiplier effect in terms of ultimate takeout or realization. But I think that's a really important point for all of us to think about, how technology is evolving, and to focus both at the equipment, services, and application aspects of it.
Great, thank you very much. I don't see any.
Yeah, I've got my hand up. I don't know, Mr. Santos. I do have a question for Chris. How much overweight are we, and what has been our return? I know, I was not on the Board of Investments last year. So what is our return last year? I know over the years, it's been sometimes north of 10, but around somewhere between 9 and 10, which has been very helpful to us. So how are we now, and how are we going to go forward with the investments? And do we think we can keep up with those kinds of returns?
Thank you, Mr. Oakham. I believe the 1-year return for the portfolio is somewhat north of 10%. Our overweight, when we say overweight, we're just really referring to the private equity portfolio. We are part of growth, and there is a lot of technology in the public market portfolio as well. But when you just compare the private equity portfolio technology weights to the MSCI ACWI, I want to say the benchmark is somewhere around 20%. We may be around in the mid 30s there. It doesn't appear that number, at least the private equity overweight, is going to be reduced quickly, because we'll still see continued investment in that space. I see capital calls, weekly, and a lot of the investments are continuing to go into tech. So I still see a big a lot of interest in that area, and just to clear up the 1-year return number, Mr. Oakham, as of September 20th, it was a little over 16%. So it's a little bit more north of 10% than I originally thought.
Thank you, Chris.
Sure.
Private equity has always been the special class for me, because we always see great returns there. Anyway, any other comments? I don't see any hands, any hidden hands that I cannot see. Hearing and seeing none. Okay, thank you. We're moving forward. We're going to subsection B, global equity education. Mr. Wright.
Good morning, Mr. Chair, members of the committee. Last month, the board inquired about the volatile trading environment and its potential impact on the LACERA portfolios. In response, staff has invited State Street to talk not only about the trading environment, but also about safeguards within our trading process that will help mitigate the potential impact to LACERA. With that, I would like to turn the mic over to Sonia Park, who will introduce today's speaker. Sonia.
Thank you, Ted. Hello and good morning, everyone. I'm Sonia Park. I oversee the LACERA relationship for State Street Global Advisors. And with me today is Nat Everts. He is our head of America's equity trading, and he'll walk through some capital markets details, as well as differences between retail and institutional investors being yourselves, LACERA. So just to give you a brief background on what we do from a trading perspective. So we have slide 2. So we are, as you're aware, one of the largest asset managers with approximately $3.5 trillion of assets under management. In 2020, we traded 3.1 trillion of notional trades across 97 global markets. And we have 32 traders globally across Boston, London, and Hong Kong. And we currently manage 15 billion for LACERA in a global equity passive index strategy. So with that, I'm going to turn it over to Nat to start the conversation. Nat, it appears you're on mute and we cannot hear you.
I apologize. Is that better?
Yes.
Can everyone hear me okay?
Yes.
Yeah.
So once again, thank you very much for having me, the committee and the trustees. In the spirit of time, this is a interesting conversation to have, and I'm going to use the time to focus in on GameStop at first, and then we can move on to safeguards. To give you a little bit of background of who I am, I run the Americas desk at State Street. I've been with the firm for roughly 23 years in a couple different capacities, trading global, and then I started their Hong Kong desk back in the late 90s, and then came back to the States, and now I've been running the Americas desk for 12 or so years. I spend a lot of time trading. I'm actually a production trader along with a manager, so I'm otherwise known as a player coach. So you might hear some bells going off in the background. That's actually trades that are occurring. But let's focus in on a couple of things that have happened, most of which focuses around GameStop. And I think the best place to start is to talk about, there's a confluence of different things that have happened, especially in retail over the last couple of years. Some of it has to do with the fact that retail is, they went to commission-free trading. And then we had the pandemic. And then there was lots of businesses and opportunities for people to explore other avenues were shut down. There was an onset of boredom that happened, frankly. And then there's a social media component. So let's look at GameStop and let's talk about equity float. So equity float is related to the amount of shares that are outstanding for a company that can be publicly traded. So it's total issuance minus restricted shares is a company's equity float. GameStop was a very popular, actually, let me back up for a second. For equity float, when you talk about trading stocks and owning stocks, there's really four things that you can do to a stock. You can either buy a stock, or you can sell a stock, or you can choose not to own a stock or not participate, or you can short a stock. And for GameStop, it had been a very popular short for the hedge fund community. It had been a popular short for a long period of time. And by the way, I'm not an analyst, I'm a trader. So I'm just following this as it affects market and sentiment. So what happened with GameStop, when I say a long period of time, think about like from 2015, GameStop was around $45. In late 2019, it traded to $4. So let's talk about shorting. And this is going to lead into a term that you hear quite a bit called short squeezing. So you have your equity float. We're going to use really round numbers just to make this easy. You have 100 million shares in your equity float, and you have 10 million shares or 10% of your float that people have shorted. So when people short stocks, it's not for the faint of heart, but essentially what they're doing is they're taking the view that the stock price at the current price is going to go down, so they don't want to buy it, but they do see an opportunity that the share price will go down and they will be able to buy cheaper and capture that spread. So there are a couple of different ways to measure short interest, one of which is percentage of float, percentage of free float, and sometimes that's expressed in a short interest ratio. And I'm going to keep this very high level. So a short interest ratio is related to the amount of shares that are outstanding as a percentage of, or the amount of its average daily volume. So what happened in GameStop was over a time period, it was shorted. It was a popular short by a lot of hedge funds. And what happened is what entered was a short squeeze. So let's talk about the short squeeze. The short squeeze that happens is when a company's equity float gets to a point where a large percentage of the shares outstanding are actually being shorted. So let's go back to the example of our stock trades at $100. And we take the view, obviously hypothetically, we take the view that we see that the stock is going to drop to We think it can go to 90, or we think it can go to 80. There's something either wrong with the company, or there's something that is fundamentally not working out, or they've been locked out of markets. But the view is that the stock can go lower. To express this view, people will go and they will borrow shares and they will sell those shares short. For this example, let's keep it at $100. So we're able to go borrow shares from a securities lending facility and sell those shares. So it's at $100 and the stock goes to 90. Our position would be that we would be positive by 10%. As this starts to occur, meaning like as more and more people start shorting, there's disclosures that show what position or what percent of the overall float is short. When the short position grows to such a point, people that are short that stock are they're gonna get potentially nervous that other people are gonna start buying that stock, or that the shorts that are short that stock are gonna wanna cover their short. When I say cover their short, meaning that's to close down their short. So let's fast forward to what the short squeeze that happened. So for a long period of time, GameStop was, as I said, it was a popular short by the hedge fund community. Earlier this year, enter the Reddit community or social media. Now the Reddit community in January was about 1.5 million subscribers on Reddit for a group or a channel called Wall Street Bets. And so what was occurring is that this group in Wall Street Bets targeted GameStop, started talking about GameStop as being, this is a heavily shorted stock by the hedge funds. We should go buy this stock and, cause pain for the hedge fund community. So in our example, we shorted stock at $100 and it went to 90. And say our view is that we think it can go lower because of X reasons. But if the people will end up covering those shorts, and if enough people cover those shorts, it'll force the stock up, which will end up causing a squeeze, and then add in social media and that element, and then you get to the GameStop. And you saw what happened in GameStop, and it happened in other areas. So that's equity float, that's short squeeze. Let's talk about the safeguards that you have and LACERA, and most importantly is my role here and State Street's role as a fiduciary. So as a fiduciary, we're an extension of LACERA. We have your interests in heart, and there's a bunch of framework that State Street has in place, whether it's counterparty restrictions, whether it's a counterparty credit department, whether it's dedicated live coverage like the person that's speaking to you now, or it's internal and external TCA, that we look at all our transaction costs and the cost of trading, as well as a governance structure that stands on top of that. So internally, we have a group called Trade Management Oversight Committee. The Trade Management Oversight Committee is responsible for looking at everything trading related. So it looks at our counterparties, it looks at our business segments, how much we are doing with different counterparties, where we are trading, the commissions that we are paying. So it's very, very transparent. When you think about what's going forward with GameStop and what we just talked about, it's not public information, and I'm not saying something that's not public information, but there are surely investigations that are going to go on, that may be going on right now by FINRA and the SEC to look at the activities of what happened in GameStop and other names. And that focus is really going to be on whether there was tactics that were being used, whether they were pump and dump strategies, or whether there was deceit that was laid out in the chat rooms or on Wall Street bets that misled investors. So it's going to end up being most likely it's going to be far more disclosure for the risks related to trading and retail. There'll be more transparency around shorting stocks, securities lending. One thing I'll also add to is shorting stocks isn't necessarily a bad thing. A lot of people short stocks for a lot of different reasons. Usually hedge funds will short stocks to either take a view on an asset that they feel is overpriced, they'll short it. But there's also a tremendous amount of hedging that goes on in the marketplace too, to be able to short. So at the end of it, I think that we'll see probably in the next couple of months, the SEC and FINRA will come out with what they've found, and there'll probably be more hearings. But for the most part, I want to stress to the committee and to the trustees that what I'm talking about here in GameStop is a very, very small part of the overall market. The market is not broken, it's very efficient. This is something new to the market related to social media and the influence, and it'll be addressed. LACERA did not trade any GameStop, and I'm open to any questions that the committee would have. Thank you.
I just have one quick question.
Ms. Sanchez, you have a question?
Yes. So I think one of the big challenges of GameStop, and we've seen it in other stocks, is that the amount shorted seemed to exceed the amount of locatable stock out there, which kind of begs the question: how do the kind of short lenders, how do the facilities, how can that have happened when those facilities are not supposed to multiply pledge the same stocks?
Well, I think that that's a good question, and there's a lot of concern around that area about whether they should be limiting the amount of lendable float of a security. I think that there's different parts of the market that would have different views on that. But I think that at the end of the day, like what we're seeing and unfortunately, I'm not super familiar with the actual mechanics of it per se, just because it's not something I'm not going and borrowing stock on a daily basis. But I think that is a topic that is going to be addressed about whether they do put limits on it or whether there is some sort of greater transparency or possible holding period that they would assign.
Okay.
Mr. Santos, go ahead, Alan. I'm sorry.
Mr. Bernstein.
Thank you, Chair Santos. I want to follow up, Mr. Everett, on Mrs. Sanchez's question. You're describing a situation where there seems to be an underlying issue of oversupply of shorts against actual things and saying that it may be addressed. I'm having a hard time understanding the situation as a problem other than the hedge fund managers got played by a bunch of Reddit nerds. And realistically, we represent a large amount of money, but we're 170,000 small investors. It really seems to me, if I'm understanding you correctly and the situation correctly, that what's happening here is that the system is rigged, and that when big players don't actually succeed in a rigged system, they stomp their feet. And I realize that you're not actually the person who's going to be reissuing the regulations, but the idea that it may be problematic, it's very problematic. The Reddit investors seem to have figured out that the game is rigged, and they figured out how to rig it in their advantage. And I would notice the irony of your appearing today is that the stock is up another 80%. I think it's massively overvalued, but I think as a prudent investor, we'd like an unrigged system. But if the takeaway is that the system is rigged, it's personally hard for me not to be rooting for the little guy here.
So I do agree with you that there are going to be some changes or some improvements in the SEC lending component of this. Please be reminded too that yes, this is a retail type phenomenon. There will be there's also a component to this as well from a stock lending side of it, and LACERA most likely partakes in a stock lending program, which is a very profitable program for people that are or is viewed as being profitable program for those that are participating in it. So there are a lot of different forces at work. I think, as I mentioned before, a lot of the focus is really going to be who is transacting in this. Was it fully retail or not? Was there deceit that was being generated? And you know where that leads to us. But you know, as I mentioned, you know, to a group here at State Street, I think that we also need, and you harp on this as well. You bring this up, is the fact that people should be able to transact in a fair and orderly market, and they should be able to express their investing views as they wish. It's just important for everybody to know the risks that are associated with that. So
I guess
think
what I'm
there'll be
saying,
more reminders.
And obviously, we put our money with large hedge funds. It is of concern to us when hedge funds lose billions of dollars. That is a great deal of concern to us. But in terms of understanding where the risk is, I'm not sure that the kids on Reddit are, I mean, I'm not sure they're uncomfortable with the risk. It actually seems to me, respectfully and conversationally, that the real people who are not comfortable with the risk are the large players who invented a rigged game or exploited a rigged game, and were shocked to find out that it didn't guarantee a result. That they seem more like petulant children than the so-called small players here. And I'm a real estate person. I have to provide now in 2021 extraordinary amounts of documentation for loans that we could practically cover with cash because of the shenanigans in the earlier part of this century. It is hard for me not to note, as somebody who does not profess to be an expert on short sales and has not participated in them very much personally with my own money, that the system seems to have been rigged. And what is shocking is that the people who were advantaged by the rigging seem to be very offended that other people discovered and exploited the fact that it's a rigged game. To me, there's no fundamental problem with shorts. It's an execution of how this system has evolved and is working. And I'm glad they're thinking about it, but I'm not highly encouraged that they're just thinking about restoring some justice to the system.
Yeah, I have a follow-up question, if I may, and then Mr. Ockham. So you mentioned the security lending program. We do have a security lending program here yeah, we do get a fee when somebody borrows the particular security. But my question is, so go back to your original example, right? You using $100 stock. So that's the price that we pay for. And so then part of the securities lending program that we have, that particular stock worth $100 is loaned out to a broker or whoever. And then that stock drops in value to 90. And then the stock is then repurchased and returned to us. So when the stock is returned to us, it's no longer $100, it's $90. So we collected a fee from the security lending piece of it. At the end of the day, the stock dropped in value when it's returned to us. And unless we keep it for many, many years after that, which we often do, we're going to lose. Is my conclusions here correct, or am I off?
Well, your stock, you already own the stock at a different level, wherever that level may be. When the person comes to you and says, I want to borrow your XYZ stock to sell, when they sell it at 100, that doesn't affect your position or your pricing. Your pricing will go down if the stock goes down to 90 in the example. That will affect your position, but you're also getting paid from lending your security out, which is going to help your P&L during that time period. But it doesn't, wherever you own the stock is where you own the stock originally, or your average price.
Good. Mr. Ockham?
Yeah, Mr. Santos, Alan Bernstein asked my question, so I don't need to ask anymore. Thank you.
Great. We're coming close to 9 o'clock, and I know the chairman of the Board of Investments already nudged me a little bit in terms of finishing up on time. Any other questions? Any closing comments by anyone? Okay, seeing none. Thank you very much for the presentation. We're moving forward to the next item is, I don't believe we have items for staff review. Good of the order. Anybody has any burning comments that you wish to make? Keeping in mind that we have the Board of Investments coming up in 5 minutes. I don't see any. Well, I will entertain a motion to adjourn, and Mr. Knox, you're going to start in what, 5 minutes?
3 minutes. I have 8:57. We'll
3
start
minutes.
at 9 a.m., please.
Okay, I needed a motion to adjourn.
So moved.
Thank you. Meeting adjourned.